Welcome to today's webinar on the legal issues arising from the failure of Silicon Valley Bank and Signature Bank. I'm Jeff Taft, one of the leaders of Mayor Brown's financial services regulatory practice. I'm based in the DC office, but as many of you have asked, I am from Boston. This is the third webinar in a series of three. We appreciate your attendance in the prior ones. If you were able to join us yesterday, you heard us discuss a number of topics, including the bank term loan program that the Federal Reserve has put out, some of the fiduciary considerations for officers and directors of institutions, and potential considerations arising from a holding company insolvency. Tonight, I'm joined by several other of my Mayor Brown partners. And before I turn it over to them, I do want to go through our standard disclaimers. We want to note that the views of the panelists today are views on the current market and are not meant to reflect legal advice. In addition, to the extent members of the press are listening today, we would remind you that the matters discussed here today are not to be considered for publication or attribution without Mayor Brown or the panelists' express written consent. If members of the press have joined in today, please reach out to Stacy Berkowitz to arrange for approval or individual discussions with the panelists. If people have questions during the program today, please type them into the chat. We will try to address those questions at the end of the program. We were able to get through many of those questions yesterday, and we hope to get through them today. So please enter your questions. To start us off today, we're going to turn it over to Matt Bazance, who's going to talk about the purchase agreement that was executed between SVB Bank and SVB Bridge Bank. Matt, why don't you start us off?
Thanks, Jeff. And for those who have not been joining for the prior ones, my name is Matt Bazance. I'm a bank regulatory partner in the firm's DC office, and I was briefly with the FDIC in the last 2008 crisis. I think something for people who've been around for a while that we have not seen is this transfer agreement that Jeff was describing, and that we're going to be posting a link to it on our resource page. That typically when the FDIC closes a bank, it does a purchase and assumption transaction with a new bank, a continuing bank that has a business, and it sells the failed bank to the bank that is continuing. And so this is a privately negotiated transaction with a purchase and assumption, so that the new bank takes on most of the assets and liabilities of the failed bank. This may come out through things like FOIA or private litigation or other ways of that documents come out of the FDIC, but it's typically redacted and it's not of particular interest because it just governs the transaction between the FDIC as receiver of the failed bank and the other institution that is acquiring the assets and liabilities of the failed bank. In this case, however, the FDIC has not sold either Signature Bank or Silicon Valley Bank to an acquirer. Instead, they have their assets and liabilities, or substantially all of them, have been put into bridge banks. And so in this case, the transfer agreement of how the FDIC got the assets and liabilities from the failed bank into the bridge bank is of considerably more interest. Among other things, the FDIC, as receiver of the failed bank, has certain superpowers that probably are not available to the bridge bank. Things like the ability to repudiate executory contracts and avoid certain claims that for defaults that again are protected by the FDIC stay provision. These probably are not available to a bridge bank, and so it's really essential for counterparties to know where their asset has landed, because we know the depositors are going to be made whole. The FDIC has said that is from the systemic risk determination, but questions as to, well, can I enforce a lending facility? Can I enforce a service contract? How will that be respected? You need to know which entity that is with. And so it's by no surprise then that I think last night, Silicon Valley Bank posted a copy of the transfer agreement of how the assets and liabilities of the failed Silicon Valley Bank were moved into Silicon Valley Bridge Bank. It's about a 75-page agreement reflecting the fact that the FDIC has been doing this for almost 90 years. It has encountered a lot of weird scenarios, edge cases, a lot of litigation. And so its standard form agreement for a transfer at this point is quite elaborate and contemplates practically every scenario you could imagine of moving assets and liabilities and other obligations between entities. It also, though, the Silicon Valley Bridge Bank model or the contract is heavily templated. There are many provisions that will end up being irrelevant. There are many items in there that reflect things that are just put in as a safeguard. And so for most people, there isn't much to get from the agreement. But the section 2 of the agreement is really where I had been spending a lot of my day looking at it, because that is the section that defines the assets, the liabilities, and the contracts that transferred but from the failed bank to the bridge bank and how they transferred. And generally, on the liabilities side, all deposits transferred. That was made clear as part of the systemic risk determination, and my read of the contract is that it is consistent with that. On the asset side, most assets transferred. There were some that did not transfer. Things like insider loans did not transfer, certain employment-related claims, certain claims in litigation, other types of contingent items did not transfer. And importantly, what are called option contracts did not transfer. And option contracts appears to be a very large universe of contracts of all types of services, leases, and other things that those did not transfer over at this point. And the reason appears to be that the FDIC's approach is that the contracts will remain in force, that the bridge bank is responsible for performing its obligations under the contract, but they will not transfer over until the bridge bank exercises an option to take those contracts. And this is going back to what I said at the beginning, that the FDIC has the power to repudiate certain types of executory contracts, whereas that is generally not available to the bridge bank. And so if the contracts had moved over to the bridge bank then and the FDIC or the bridge bank had decided that it did not want to adhere to the contract, there wouldn't have been anything the bridge bank could do. But by putting this option in place, the bridge bank and the will continue to perform under the contract. But if the FDIC decides that it wants to repudiate it, it can do so because the contract has remained with the receivership. And at some point over the next couple of months, the bridge bank will identify those contracts that it would like to transfer. Those contracts will be transferred out of the receivership estate into the bridge bank, and then they will no longer be subject to repudiation risk. There also is a provision in the contract saying that for assets that have transferred over, the FDIC has a put and call right, that it can call assets back from the bridge bank that have been transferred over, and for the remaining assets that have not been transferred over, the FDIC can decide to move them over to the bridge bank at a later date. Now, this is important for two reasons. The first, for assets that are still in the receivership that have not been transferred, the FDIC can transfer those using its superpowers. And so it doesn't need borrower consent. It doesn't need syndicate consent. It doesn't need anything. It can just say, I am transferring this as the FDIC to a new holder, and that person takes on all the rights as if they were the original Silicon Valley Bank. Once things go to the bridge bank, that is not the case. The bridge bank is thereafter bound by the terms of the contract with the borrower, whomever. And so the bridge bank really does not have the superpower to transfer things on without any requisite consents. Therefore, there is a provision saying that if the FDIC exercises its call right to recall assets from the bridge bank, that would be subject to any intervening requirements. So if there is a contractual right of consent, if there's an issue of illegality, unlikely it would be an issue of illegality, but just overall, the transfer agreement recognizes that the bridge bank will be bound by the contract in its ability to transfer things back to the receivership. I'm not expecting there to be too many types of contracts where there are consents that the FDIC wants to transfer back. that for some reason it cannot, that typically the things it might seek to transfer back would be more unusual types of assets where there's a concern of fraud or other types of edge cases. But I did think that was worth noting, because that was something that is not present in the put, that the FDIC can put anything from the receivership into the bridge bank, but the call right is limited by applicable contract and other laws. The last item I will cover from the transfer agreement is that it is a private agreement, and so it does not create rights typically for third parties. It's not as if someone can go and say, well, I would like to enforce this part of the transfer agreement, that it's between the FDIC as receiver of the failed Silicon Valley Bank and Silicon Valley Bridge Bank as the new entity. And so it is a private contract in that regard. And so it is an interesting read. It is important for determining whether something has transferred, but it isn't like a regulation or something that you can go citing to take affirmative action. Jeff, do you have anything you'd like to add to that commentary?
No, I would just say that I think it's probably worth folks taking a look at the agreement. Again, it's going to be posted on the website. You can probably get it elsewhere as well. Just to kind of see, because we've been getting a lot of questions about how this happened, how it occurred, what are the rights under the agreement. So I do encourage people, when they have some time and things kind of quiet down, hopefully a little bit in the near future, they take a look at that agreement as well, because I think there are some things to look at. Thanks, Matt. I appreciate it. So moving along the agenda here, last night we had Larry Cunningham, who spoke about fiduciary obligations of officers and directors. Today we have Adam Cantor, who's going to join us and talk a little bit about some of the obligations of investment advisors and others, what fiduciary obligations they may have.
Thanks, Jeff. So hi, everyone. I'm Adam Cantor. I'm a partner in our DC office in our investment management group. And as Jeff said, I'm going to talk a little bit about the fiduciary obligations of investment advisors. And I'm going to talk a little bit both in a retrospective view as well as in a forward-looking view. I think the first thing to think about is, of course, leading up to Thursday and Friday of last week, as we saw things beginning to deteriorate. I think a lot of investment advisors who are fiduciaries under the Advisors Act have an obligation to their clients to, which included, venture capital funds and other funds and vehicles and clients, to safeguard the assets of those clients. And so you actually have this kind of counter intuitive situation where once a bank run becomes more likely, you actually have an obligation to protect your client's assets, which could further precipitate a bank run. And we saw a lot of that in action as things were deteriorating and people were, desperate to get their funds assets out of a potentially failing bank and try to move those assets to other accounts, other banks. And that is an issue where, and that's sort of an ever-present issue that advisors are constantly trying to be good stewards of their clients' assets. And so it's kind of a broader issue where, I think from our view, advisors need to be doing, and should be on an ongoing basis, be doing kind of comprehensive counterparty review. And that's, diligence on counterparties, especially if the advisor was in the position, as is typical for a fund, where they were the one who selected, a custodian, or they are the one who is selecting, who is going to be the provider of a subline facility or NAV facility for a fund. Choosing and diligencing counterparties and doing so on an ongoing basis, and also monitoring counterparty concentration risk, where if you're doing all of your banking, all of your lending with a single counterparty across all of your funds, you could end up having, potentially too many points of contact with a single financial institution, where any issues impacting that institution could have an outsized impact on your clients. So I think some amount of diversification can be not necessarily required, but can be a good measure and consistent with the advisor's fiduciary duty to, again, be a good steward of their clients' assets and try to maintain value for client assets. Now, one of the things we saw as the situations were evolving is it became very difficult to actually get the money out, or really, again, for for funds and fund managers that were concentrating a lot of their relationships within a single financial institution didn't necessarily have accounts to move money into. And we saw situations that, kind of ran into issues under the custody rule, under the Advisors Act. Now, this didn't necessarily impact many VC advisors who are exempt from regulation, but for advisors that were registered, there are a lot of specific restrictions on what types of accounts they can move money into and how those accounts are held and for whose benefit they're held. So for advisors that were trying to move money in a hurry last week, they were running into issues under the custody rule about, we saw various, questions ranging from, can I move the fund's money into my personal account and then give it back to the fund on Monday when things settle down? Can I move it into, a dormant account in the name of the advisor? Can I move it, can I move portfolio company money into the advisor's account or into a personal account, again, on a temporary basis under the theory that it's more, it's consistent with the fiduciary duty to, again, under my first point, to try to get that money out and keep the money safe. Well, at the same time, you run into the issues under the custody rule about whether that money can actually be in that account, because you are generally prohibited from commingling proprietary assets with client assets, and any client assets have to be held on a basis that is for the client's benefit and not cannot be viewed as for the advisor's benefit. So we ran into all sorts of those issues last week. And then I think, as we come out of this, as I said, I think a lot of advisors are going to be doing this process of counterparty review, counterparty concentration review, to identify situations where they may need to diversify counterparties. And the other issue that we saw coming out of this is a disclosure issue where, I think especially, Friday, Monday, Tuesday this week, we had a lot of advisors that were reaching out to clients trying to give disclosure and to fund investors about, here's where our exposure is, especially, and some of this has become moot by now. But when it was still unclear, were depositors going to be made whole? What were the obligations there? What was the exposure there? A lot of advisors were kind of reaching out to investors, making sometimes broad or potentially overbroad statements regarding what the exposure was. We either we don't have any deposits there, or we're not aware of any kind of financial interconnection with with the banks. And I think from our perspective and in advising clients, again, as a fiduciary, was to try to make sure that we're being open and forthright, but also making sure that we're reserving that there is further investigation to be done, especially when you have to untangle some of these potentially complicated financial arrangements where, they could be a syndicate member on a, lending facility that they weren't necessarily the direct lender, so you might not be thinking about them as being involved and might not having exposure to them. But it's one of those issues where we certainly wanted to make sure that we were being honest and forthright with the investors and the clients, and then that's been kind of a good process that I think people will be, in the event of any future issues similar to this, will be kind of incorporating that same process and really, again, tying that up back to the kind of counterparty concentration issues and counterparty diligence. Keeping tabs on where your exposures are can help you, if you have to make one of these kinds of statements to your investors, knowing where the mine, where the various mines are in the minefield can steer you in the right direction of, being able to know in advance, where are our exposures, where do we have potential issues, and where do we have, and what do we need to be thinking about when we make these kinds of disclosures. So, and I guess the last part that I'll touch on, again, just on a forward-looking basis, is really about prudent cash management activities. So again, whether that means diversifying where you're keeping deposits, I think it's fairly typical for a lot of funds to just have a single custodian, and I think we've seen potentially some of the downsides of having that concentration in a single financial institution. So it's so far so good, I think, for the most part on the fund side. But again, as fiduciaries, you always have to be on the lookout for, where potential harm could be coming to clients and client assets, and kind of being proactive in making sure that you don't get caught flat-footed.
Thanks, Adam. That's really helpful. I get one quick question for you, and then I may follow up and ask Megan a question because she had talked about something very similar on Monday's program. I understand, obviously, the advisor has a fiduciary obligation to do certain things. I am a little bit more perplexed about whether there's a reason that they would have to publicly make statements about what they did or what they didn't do. I mean, is that really part of the fiduciary obligation, or is that just more of people speaking to the public because they want to speak to the public?
I think it's probably more of the latter. There's certainly no obligation to go and put out a press release or get on a soapbox and start talking about what you're doing. You do have an obligation to act and to act decisively to again protect client assets, but that doesn't mean that you should be saying anything publicly that could actually precipitate more of the problem.
Right. So you're a fiduciary for your clients, not the general public. I get it.
That's right.
So I think with that, let me turn it over now to Michael. I think he's going to talk about a little bit of a similar issue, which comes up obviously in the real estate space. And it's something that we've all been talking about this week. And I'm glad we could get him on to kind of talk about that. So Michael, maybe you want to talk about some of those issues you're seeing in the real estate space and how kind of ties into what Adam and I think Megan were talking about.
Sure. Thanks, Jeff. Thanks for having me, everyone. And I'm Michael Weiss. I'm a real estate partner in the New York office. My practice is generally split between, in the real estate finance side, between representing borrowers and lenders. So I've spent the better part of the last 96 hours kind of triaging the needs of both borrowers and lenders and seeing what is popping up in the market. I will say, kind of in the real estate space, there's the immediate needs of what's going on between SVB and Signature, and then there's the long-term or I'll say near-term focus, and some of those issues have been put off a little bit this week, but are probably just equally as important. So for any borrowers banking with SVB or Signature, the immediate issues that we saw were what's going to happen to our loan. Obviously, that's pretty established at this point, but I think the piece that is still a little bit up in the air is what happens to their construction loans, if any. I have not had the pleasure of working with SVB on the real estate side, but we do a lot in New York with Signature. Signature is one of, if not, I think the third largest commercial real estate lender in the New York City market. They possibly are the largest multifamily lender in the New York City market. So on the borrower side, you have a lot of concern about how does my loan get serviced as especially for construction loans, where will I get a draw the next time I need it to continue construction? But even more importantly, Signature is one of the largest lockbox service providers in the country. So they operate lockbox and cash management functions for many, many lenders who want the rents from a specific property to be paid into that lockbox and then run through a cash management waterfall, or barring an event of default, released to that borrower for payment of operating expenses and debt service. So the immediate concern that we got from a lot of clients with respect to Signature directly was, what do we do with our tenants? Do we have to direct them to pay to new lockboxes? How are we going to trap this cash, and how do we know that rents that come due at the end of the month are going to be paid? Especially since at the end of the day, anybody who's listening to this is probably a relatively sophisticated player, but when you're talking about multifamily rents, especially in the New York City market, there are hundreds of thousands, if not millions, of unsophisticated, ordinary citizens who hear that the bank account that they may be paying their rent to every month, the bank just got taken over, and now they might think they don't have to pay their rent that month. So we have plenty of concerned landlord clients who didn't know if they needed to send new rent direction letters to all their tenants, how to handle that situation with Signature. The short answer is they shouldn't have to. Signature's made it very clear that the lockbox services have been transferred over to the Bridge Bank, and because of public statements and the press releases that have been made, there should not be any need to send further notices to tenants as to where they should pay. But a lot of landlords are not heeding that advice and are preparing tenant notices once again, saying where they should be paid. So that's kind of the immediate issue with Signature and SVB. As I said, construction lending is probably the biggest issue that is still on the minds of many, many borrowers going forward, especially with other regional banks. That there has been plenty of news media coverage about what banks people may need to be concerned about. There's obviously a trade-off for those borrower clients that already have outstanding construction loans with some of those regional banks. The concern seems to be what happens if those banks close and they don't get bailed out the same way as Signature and SVB. Will my construction loan be repudiated if that happens? And how do I plug the gap to get to completion on my project when the construction funds may stop even for some period of time? I can't fall behind on construction. That's a big deal for us. We're tied to delivery dates, and we have markets that we have to hit and metrics that we have to hit. Otherwise, either our loan goes into default or their joint venture goes into default, etc. So construction lending is one space that's a little bit uncomfortable in the market at the moment. The other one, as I said, is probably what to do with lockbox services going forward. Signature filled such a large role within that market. Are people going to continue to rely on the bridge bank to offer new lockbox management, cash management services, or are they going to look elsewhere? And if they're going to look elsewhere, who is possibly going to fill that void in the market? Because negotiating deposit account control agreements and putting in place cash management for commercial real estate properties is not a fast process. And if this needs to get done between now and the end of the month, that process really needs to start now, if not prior to now. So that's probably the four kind of real issues we've been seeing in the real estate space. Obviously, there's also what to do with warehouse lines of credit. I think you guys have already spoken about that a little bit in your webinars this week, so I won't get into too much depth with it. But there's also just the obvious of replacement of trustees and escrow agents. Especially with some of the regional banks that have been in the news, that's a large part of their business as well. And do people want to continue to rely on those banks for those services going forward? Or should they just operate like business as usual? So.
Thanks, Michael. I think you hit on a couple of points that a lot of clients have been asking about the last couple of days. Once it became clear that the bridge banks were going to perform their obligations, and their counterparties were expected to perform their obligations, I think with respect to these two banks, some of the pressure was off. I do think that, as you say, there are, people are concerned about other banks and whether they would be, treated in a similar way. Also, we're getting a lot of questions about, continuing to bank with the bridge banks and whether they should be proactively, moving their accounts or things like that onto other banks. And one of the questions people are asking in that regard is, well, how long are the bridge banks going to be around? And I think the answer that we're giving is until they find somebody to buy them. I don't think anybody really knows. I think everybody recognizes it is temporary. It's just a question of how temporary. I think there were a lot of people who were trying to move things this week very hastily and then decided maybe that wasn't necessary at this point. But to your point about lockboxes, it's setting up those arrangements. You could either wait for the bridge bank to be acquired by somebody and have a new bank by their choice, or potentially you could proactively, I'll go out and address this. And I think that's what a lot of clients are struggling with right now. Now that they've kind of got over that initial concern that the banks wouldn't perform, now that they're performing, it's kind of back in their court. And I think that a lot of clients, as you say, are thinking about that.
Yeah, and a large part of this is relationship driven, and it's going to depend on who's working at the bridge banks, whether their contacts are at the bridge banks or not. And that's still to be foreseen a little bit. So I think where we're seeing some of the real trepidation is just figuring out for systematic programs where to go for this going forward. And I'm not sure anybody has an answer to that yet.
That, ultimately that could be some of the franchise value for the Signature Bridge Bank. So we'll see how that works out. But thank you for coming on. Appreciate it.
Absolutely.
Let's move to the international scene. As our colleague Debbie Shaw talked about on Monday's program, this isn't just a US issue. Obviously, Silicon Valley Bank, for example, had a UK bank, and they have branches in a number of other countries. Here to talk a little bit about this and the knock-on effect in the UK is our colleague Chris Chapman. Chris.
Thanks, Jeff. And for those of you who don't know me, I'm a partner in our financial services regulatory practice in London. There have been some articles in the UK media today about whether the issues we've been discussing will affect the future of financial services regulation in the UK. The context is that the UK government is currently proposing changes to its financial services regulatory regime following Brexit, including loosening the regime in some areas and trying to make it more competitive. And the articles have questioned whether it will need to rethink that approach. So we thought that might be quite an interesting thing to talk about for just a few minutes on this call. For me, maybe the most important factor to bear in mind is that we are due to have an election in the UK in the next 2 years, maybe significantly sooner than that. And the current government, based on the polls at the moment, is very likely not to remain in power. There's a real question about what in practice they can achieve before the election in terms of any substantive changes. Just as one example, one of the things they're proposing to do is just simply to move thousands of rules and regulations that currently sit in a mixture of UK and EU instruments into entirely UK instruments. Now that in itself is a huge exercise. Lots of people are questioning whether they can sufficiently consult on that and achieve that before the election, just in and of itself. So real questions about whether actually they have the ability to make substantive changes that they're proposing to the regulatory regime. And also, of course, questions about how that will work politically if the incoming Labour government doesn't agree with their proposal. So in particular, it's expected that the Labour government would not be as keen on any loosening. Just in terms of whether or not it is a good idea to loosen the UK regulatory regime or to tighten it or to leave it as it is, that is, of course, a really difficult question. It certainly will be the case that the recent developments will cause people to question whether loosening is a good idea. But I also think it's important to remember that actually the UK is one of those jurisdictions where loosening won't necessarily attract net business to the jurisdiction. So, for example, there are a number of firms, especially large firms that serve institutional clients, who are attracted to the UK and similar jurisdictions because it's tightly regulated and because that's good for their reputation. Another thing to remember is that, of course, the UK government might have a desire to enhance the competitiveness of the UK regime, but it can't do that it can't expect to do that in a vacuum, right? The other jurisdictions, and in particular the EU, will react. There are lots of things the EU could do if it wanted to increase its own competitiveness or to undermine the competitiveness of the UK. So sort of a lot of questions in any event about whether loosening ever would have been a good idea. The other major thing to just note here about the UK at the moment is these considerations are hugely political. So, and they're quite closely tied up with the current government's policy in relation to Brexit and their desire to try to find some sort of manifest advantage of Brexit that they can point to. And they've said that changes to the financial services regime could be an example. So there are people that are quite concerned that they may try to rush through loosening without proper consultation in order to fulfill that political objective. There's other people that don't think that will happen. There's other people that think, do you know what, in the time that's available, all they'll have time to do is to sort of lift and shift the current law without changing anything. So really a lot of uncertainty about what's going to happen. I'd say in summary, look, of course, in the UK, like other jurisdictions, these recent developments are going to cause people to think whether it's a good idea to loosen current regulatory regimes or to tighten them. If you are sitting there thinking, well, what does the future of the UK regulatory regime look like and how might this change? I think one thing to bear in mind is despite what some of the messaging is, it may not necessarily have been the case that the UK regime was going to be substantially loosened in any event. So those were just some thoughts on that issue and what's going on in the UK.
Thanks, Chris. I think it's always helpful in this global economy to have that kind of perspective across borders. I guess the one question I would ask you, and obviously we see a little bit of this when we look at the Financial Times and some of the other European papers, is has this changed at all? You think the way that other countries or other regulators are looking at the U.S. financial services system, or what's happened here and taking it as a lesson learned or some general concern that's out there?
Yeah, I think people will see, will be really interested in whether the US market is leading a trend into other markets. I think there is talk about whether or not the US regime has loosened itself recently, but I don't think that's the international perspective of the US regime. I think the US financial services regulation is seen as pretty sophisticated and robust. So I think what people are concerned about is whether this is an indication of other issues that are going to arise in Europe and the UK.
Yeah, I think that's helpful. I mean, obviously, we in the U.S. think of ourselves as leaders, which is fine until it comes to some sort of financial crisis, and then we don't necessarily want to be leaders of that. So we appreciate that perspective. I think, Megan, I want to just turn it back to you to see if you had any kind of thoughts. I know in the last couple of programs, you've talked a little bit about risk management, risk taxonomies and things of that nature, and then let us into our Q&A. So I want to just kind of turn it back to you for a minute.
That sounds great. For those of you who I haven't met before or haven't been on these webinars, I'm Megan Webster. I'm a partner in our Chicago and New York offices in our litigation and enforcement group, but focus my practice helping our clients navigate through regulatory compliance transactions and complex litigation matters, often in cross-disciplinary areas, but I have a particular expertise in financial institutions and other highly regulated industries. As Jeff mentioned, we've discussed on a couple of our other webinars here, the need to have a nimble crisis management playbook. And several of our partners and colleagues assist our clients with developing those. And we really saw the need to have those playbooks and execute on them during this situation. We also touched a bit on the treasury management point and the need for diversification. And then finally, I thought today we could talk a bit about and answer some of the questions that have arisen about the need to have a good risk management program, not just if you're at a financial institution, but also across industries. And we received several questions regarding what is interest rate risk. And I'll discuss that briefly today, but before I dive into that, and Matt, please feel free to jump in here, but a risk taxonomy that we've been talking about is really a comprehensive set of risk categories that you use as an organization to try and measure your risk and to identify risks and consider those risks that could impact your organization. and when people were asking what is interest rate risk, I think the easiest way in this environment is to point them back to the FDIC. And the FDIC actually defines interest rate risk, where it, in the banking context, is the exposure of the bank's current or future earnings and the capital that's needed to the capital adverse to those changes in the market rates. Normally, this is part of banking and can be an important source of profitability and shareholder value. However, excessive interest rate risk can threaten the bank's earning capital, liquidity, earnings, and solvency. Therefore, and I'll read directly from the FDIC on this, it's important to effectively identify, measure, monitor, and control interest rate risk exposure through effective policies and risk management processes. And we've gotten a lot of questions from our clients and others in the industry whether or not this is a new issue. And actually, there's been joint agency policy statements on interest rate risk dating back to even 1996. So what we're dealing with when we talk about risk management is not necessarily a new concept, but something that the banks have been using for quite some time. But also we are seeing other sophisticated organizations try to implement a tailored risk taxonomy and really a dashboard to help them lead through the ability to measure, monitor, and control risks. And importantly, tying into what our colleague Larry Cunningham spoke about yesterday, was the need to really talk with it about your board, with your boards and executives. So really using those tools to monitor the risks in the marketplace. Now, I know that we've got some questions in the Q&A. We want to answer all those questions, but for those of you who have additional questions, you'll see the tool function here on the WebEx that you can hit Q&A and type those in, and we'll try to get to as many as we can here. But Jeff, unless you or Matt want to add anything to talk about interest rate risk or anything else, I think we might be able to turn it over to Q&As.
Let's move to the Q&A. Obviously mindful of people's time, the dinner hour here on the East Coast and the like. So let's just dive into it.
Perfect. It is the eve of March Madness. So I think one of them is, would the announced special levy to cover potential FDIC losses regarding SVB be accessible against uninsured U.S. branches or agencies of foreign banks?
So I can take that one, Megan.
Great.
I think we don't have the details on it yet, and I think we've already seen some people in Congress saying that they would like to have a say in how the assessment is done. Some proposals saying, well, it should be tailored only to certain larger banks, or it should be on a sliding scale. And so I don't think that even now we can say with certainty how it will be assessed. But based on the limited statements released so far by the regulators, I would expect it to be done as part of the deposit insurance assessment process. That there have been various special levies over the years for different things coming out of the 2008 financial crisis. And so I would expect it to be done through that process. Uninsured branches of foreign banks and foreign banks are not subject to the FDIC deposit insurance assessment program. They typically pay a annual assessment to NYDFS as their regulator. If they are a uninsured federal branch of a foreign bank, they might pay a fee to the OCC. And depending on their holding company and the structure in the US, they might pay a large BHC assessment to the Federal Reserve, but they are not subject to the FDIC assessment process. So if as I'm predicting, the special assessment is done through the deposit insurance assessment process, then it would not apply to US branches and agencies of foreign banks, or uninsured US branches and agencies of foreign banks.
Thanks, Matt. The second question that I think is important here is with regard to counterparty diversification, does a fund advisor's obligation extend to ensuring that portfolio companies' counterparty risk is diversified? Our audience member said, in other words, looking at the fund's portfolio on a holistic basis.
So I think I can take that one, Megan.
Great.
So I think it's important to have some insight into, especially if you're talking, in the private equity space, let's say, instead of VC, where there's sometimes a little bit more hands-on role of the manager in how the portfolio companies are operated. In VC, where you might be one of several, investors in a venture capital or in a kind of an early stage company, depending on your level of influence, your level of insight into their counterparties and their operations, it may not be as appropriate. It's good to, if you have insight into that, I think you should consider it. And I think it can be part of your discussions with portfolio companies about what they're doing. I think we saw a lot of that last week, actually, which is, VCs knew that their portfolio companies were heavily, concentrated in SVB, and were actively encouraging them, to move money out when they could, and to otherwise take action. So, holistically, yeah, I think it's good to be able to have that kind of look at where the overall exposure is, just from a prudential perspective and as a fiduciary. That doesn't necessarily mean you need to tell your portfolio companies you need to bank elsewhere, or you need to have multiple banking relationships. That may not be realistic, but having, the understanding that, hey, this is where some pressure points are, so that if something does hit the news, where your exposure is. I think that is helpful.
Agree. Any other thoughts from the panel? I think we were trying to be mindful of everybody's time this afternoon, in light of that this is our third installment. So over back to you, Jeff, to see if there are any other questions that we should cover. Of course, if there are any questions, we always welcome you to reach out to us. But Jeff, I think that covers the majority of them.
Well, thanks, Megan, and thanks, obviously, everybody for participating today. I want to extend a thank you to the audience as well for joining us the past 3 days. And if you missed any of those programs, they are available and recorded on our website, or you can direct your colleagues or friends to them as well. While this is the last of our initial 3-part series, we will return as both domestic and international developments arise and warrant. We will also continue to update our resource page, so you can come to the resource page if you're looking for information around both SVB and Signature and any other developments that may come up. I guess in closing, I'd say have a good evening, and don't forget to fill out those brackets, because there's not going to be a do-over there. So get them in, and have a good night, everybody.
Thanks, everyone.